We are covering the Guaranteed Insurability Rider for the National Life Insurance Exam today. This specific rider is one of the most frequently tested concepts because it addresses the core risk of becoming uninsurable. On the exam, you will likely see a scenario where a policy owner wants to increase their death benefit but has recently been diagnosed with a health condition like diabetes or heart disease. The Guaranteed Insurability Rider is the solution because it allows the policy owner to purchase additional amounts of life insurance at specified future dates or following specific life events, without having to provide any evidence of insurability. This means no medical exams and no health questionnaires are required for the additional coverage. You must remember that the exam often focuses on the timing of these options. Coverage cannot be added at any random time the policy owner chooses. Instead, the rider specifies option dates, which are typically every 3 years, such as at ages 25, 28, 31, 34, 37, and 40. Beyond the chronological milestones, certain life events also trigger these options. If the insured gets married or has a child, the rider allows them to skip the next scheduled age option and buy the coverage immediately. A major trap on the exam involves the cost of this additional insurance. Test questions will try to trick you into thinking the new coverage is priced at the original age of the insured when they first bought the policy. This is incorrect. The premium for the additional insurance is always based on the attained age of the insured at the time the option is exercised. If you bought your base policy at age 25 and exercise a guaranteed insurability option at age 35, you will pay the premium rate for a 35-year-old for that new block of coverage. Another common point of confusion is the maximum age limit. Most insurers will stop offering these options once the insured reaches age 40. If the exam asks about a 50-year-old trying to use this rider to bypass a medical exam, the answer is likely that the rider has already expired. You should also be aware of the 90-day window. Usually, the policy owner has about 30 to 90 days to exercise the option once the date or event occurs, and if they miss that window, they must wait until the next scheduled option date. To help you remember the core purpose of this rider, use the mnemonic phrase GIR equals go in regardless. This reminds you that regardless of your health status or how many medical issues you have developed, you can go in and get more insurance. When you see a question asking which rider allows a person with a terminal illness to still increase their death benefit, the Guaranteed Insurability Rider is your answer. You might also see questions asking what happens if an option is skipped. If the policy owner chooses not to buy additional coverage at age 28, they do not lose the rider. They simply wait until the next option at age 31. However, they cannot go back and buy the amount they passed up later. The exam will test your ability to distinguish this from the double indemnity or accidental death rider, so keep your focus strictly on the lack of a medical exam requirement. This rider is designed to protect the future insurability of young adults whose income and families are expected to grow even if their health does not remain perfect.